In the winter of 1997, one trader signed a contract that effectively crippled a national economy. Without building a single factory or hiring a single worker, he walked away with $2 billion. At the time, Thailand was the Asian miracle. In a single decade, the country shifted from a quiet agrarian society to a landscape of superhighways and skyscrapers, driving an 800% growth in their stock market index. This growth was fueled by a shift in Japan. In 1985, the United States led the signing of the Plaza Accord, which caused the Japanese yen to surge. Suddenly, Japanese labor costs doubled in dollar value, forcing giants like Toyota and Sony to move their manufacturing to the ultra-cheap factories of Thailand. This influx of foreign capital created an era of record-breaking expansion, but it also left the Thai economy entirely dependent on the continued confidence of external investors. To keep those foreign corporations from worrying about currency fluctuations, the Central Bank of Thailand made a specific guarantee to the market. They established a fixed currency rate. The government promised that, regardless of market demand, exactly 25 Thai baht would always be worth $1. Hedge funds spotted a flaw in this promise. They realized that by pegging the baht to the dollar, the Thai government was trying to defy the natural movements of the free market, creating a mathematical loophole for anyone with enough capital to exploit. By prioritizing the comfort of foreign corporations over market reality, Thailand had built its economic miracle on a foundation that could be dismantled by a single, well-timed trade. The tool used for this trade was a forward currency contract, a legal agreement to exchange one currency for another at a fixed rate on a specific date in the future. Soros and his associates signed contracts promising to hand over 25 billion baht in exactly 6 months. In exchange, the commercial banks promised to give them $1 billion, based strictly on the government's 25-to-1 guarantee. To ensure they would have that $1 billion ready when the contract matured, the commercial banks immediately began selling their Thai baht back to the central bank. Because of the 25-to-1 promise, the central bank was legally obligated to buy all that baht, which meant they had to pay out their own limited physical reserves of US dollars. The trade effectively weaponized Thailand's own promise against it, forcing the government to drain its own foreign reserves to honor a series of private contracts. By July 1997, the central bank reached a breaking point. They had paid out over $23 billion to commercial banks and were left with just $2.8 billion in reserve. At the time, Thailand needed $4 billion just to pay for the oil imports required to keep the country running. They were technically bankrupt. On July 2nd, the bank surrendered. They announced they could no longer maintain the fixed rate and would let market forces determine the baht's value. The baht's value halved almost instantly. 6 months later, Soros bought the 25 billion baht he owed for just $500 million, handed it to the bank to fulfill his contract, and collected the $1 billion he was promised. By utilizing the central bank's own rigid rules, investors facilitated a $1 billion payout that left the national treasury empty. As the financial math played out in New York, the consequences hit the streets of Bangkok. Poverty rates climbed from 35% to 45%, and the price of basic necessities like fuel doubled overnight. With the currency in free fall, major businesses and real estate firms collapsed, leading to mass layoffs and a sharp rise in the national suicide rate. The Southorn Unique Tower remains the most visible symbol of this collapse. It was an 80% finished luxury skyscraper that was abandoned mid-construction and left to rot as a monument to the crisis. It took nearly a decade of stagnant growth before Thailand's GDP finally returned to its pre-1997 levels, proving that these trades had a lasting impact on the nation's trajectory. The 1997 crash left a lasting mark on Thailand's economic policy, making the government deeply cautious about future market volatility. To prevent another attack on the baht, Thailand began hoarding massive foreign reserves, which now exceed $220 billion. They prioritized building a defensive wall of cash over investing in long-term development. This focus on safety came at a cost. While neighboring Vietnam aggressively courted high-tech manufacturing, Thailand's electronics exports stagnated. By locking their capital in reserves, they missed the window to transition their economy into higher-value industries. Regional competitors like South Korea used their growth to invest in research and development, turning their workers into engineers. In contrast, Thailand's lack of investment in education and technology has left it as an aging society caught in a middle-income trap. The events of 1997 showed that trying to control a free market often results in losing it entirely. Thailand survived the initial crash, but the defensive posture it adopted in response continues to slow its progress today.